But let's turn back now to the major indexes. So joining me is Doug Flynn, co-founder of Flynn Zito Capital Management, which specializes in investment management and financial planning. Doug, it's good to see you. Thanks for coming on the show.
Good to see you, Kristen.
So a busy day across America with these midterm elections, ongoing earnings reports still coming in, including this key report from Disney ahead of the inflation read that we'll get on Thursday. But back-to-back days of gains in the stock market. What's your current pulse on the state of things in the stock market?
Well, you've got a couple, there's positives and negatives as usual, but the positives now are you have the November to May seasonality, which is the best time of the year, the best 6 months of the year. So you have that as a backdrop. You have the prospects for divided government, which no matter who's in power, when the other side is not, when the other side is also in power, you have that mix. It tends to bode well for the markets. And you have tech really oversold. It's been way overdone. That doesn't mean it can't suffer some more, but there's some oversold nature to that. So that's on the positives. And then on the negatives, of course, you have inflation, the prospects of that staying higher for longer. You have the volatility and you have the fears of recession as the backdrop. So that's what's going on, and the balance of that is happening as we speak.
So I guess maybe a relief rally to some extent, Doug, is what we would consider these past 2 days of this week. Generally speaking, though, third quarter results, they've been coming in a bit better than expected. Not as many companies beating per usual, but still actually showing growth here in the third quarter. What is the overall health of corporate America that we can gauge from these reports in the stock market?
Yeah, it's interesting. The current numbers are almost not as important as the future guidance that each one is going to give you, because the likelihood of us going into recession next year is getting higher and higher because the Fed is probably going to have to keep rates higher for longer than they want to try to keep pushing down inflation. And so you really have to look at, if we go into a recession next year, when do we, how deep is it, and what kind of layoffs might there be, because those are coming. And you start to see a little bit of that with tech, but right now it's being offset by gains in the hospitality and travel and other areas which are booming from an employment standpoint, while other parts are laying off. So we're not seeing it across the board. So I'm really looking at almost not even what we're doing now, but what's the future guidance from each of these companies? How do they see the future? That's really the key on where you can get your cue from what to do from here.
Okay, so for Americans watching, they might have money in the stock market, but they also, Doug, to your point, might be concerned that they could lose their job as the price of everyday items across the board continue to rise quite dramatically at the fastest pace that we've seen in nearly 4 decades. What kind of industries, sectors could see the most layoffs, and what should Americans know when thinking about how to manage their own balance sheet, their own budget here into the new year?
Well, it's a great question, because right now the Fed is really, when they're pushing interest rates higher, they're really focusing in on the 20% of GDP, which they can control, and that's the goods sector. So if you're in the area of delivering goods or manufacturing goods in that area, that's the area that's going to come under pressure. They really don't have as much control in the services area. They really don't, have a lot of sway in terms of that. So your layoffs aren't really going to come from those areas as people in the beginning right now. Look, a lot of people decided they didn't travel for a long time. They're going to travel no matter what. So they're making up for some lost time. Now, eventually, as people have less money, they spend whatever money they have, and maybe they lose their jobs and have less, those things will go by the wayside. And so you're really, you're kind of navigating the tale of two different things at the moment. And what you have going on right now might look very differently in about 6 to 12 months. And so that's really the problem, is what kind of financial cushion do you still have left over from when things were pretty good? Are you still in good shape, or do you have a little bit less because you kept spending, like thinking that right now there might be 3 jobs for every 1 person? What if we go to 3 people for every 1 job? How are you going to fare?
Okay, let's talk about the midterms because we discussed it a bit off the top, but obviously it's keenly in focus for Americans and investors today. We've seen, since Biden's been president for just under 2 years now, some major policies, get pushed through worth trillions of dollars. Even though they've said the deficit has been reduced over time, at least in these past 12 months or so. What does gridlock in Washington truly mean for the stock market?
So If you take a look at all the previous midterm elections, and that's really what you have right now, is you have a midterm election. It's really quite interesting. If you look at 6 months later, on average, the market's up about 14%. A year later, off the low, and the low might have been June. We don't know that. We'll know that the further we go. But if the low was June, the typical 1 year return on the market from that low, whenever it's achieved, is over 30%. Now, when you have divided government, when you have one party in power and either one or both houses the opposite, those numbers are higher. When they retain all the power, those numbers are lower, but those are the averages. And so right now it sets us up pretty good for an equity market and a stock market run. And that's when I get fearful. If we do get this nice rally here, because all of the factors we're talking about, then we're looking at a pending recession when equities may not do as well. And that's when you really want to give some serious consideration to fixed income, to bonds. And for the younger people, bonds, bond is a four-letter word to young people. They don't even know what it is, and they haven't invested in it because it's not exciting. But you want to look at that after the next run, maybe taking some profits off the table there, because that's the way we see it right now.
What's the best way, Doug, that you would advise investors to add some exposure in the bond market?
Yeah, so right now, if there's two types, right? If you have your retirement accounts, you're going to do more traditional fixed income and typical corporate and government bonds. Those yields are quite high compared to where they were before, and their pricing is way down. You're buying it cheap because as rates keep going up, those prices are coming down. That's how that works. In taxable accounts, more liquid accounts, there is an unbelievable opportunity in tax-free municipal bonds. And quite honestly, the states, which are always a concern whether or not they're going to be able to pay back, are in probably some of the best financial shape they've been in decades, because they still have all that COVID money and a lot of the other money that was pushed down from the government. So there's a lot less fear of those not being able to pay. And so when you look with your more liquid and taxable dollars, you're looking at tax-free municipal bonds, where right now you can get A-rated or AA or AAA with a 5+% yield, and they're trading below their face value. That, when you go into a recession and bonds actually do what they're supposed to do, that could be quite a good year in the bond market in the next couple of years. So look to that. If you don't have any, if you haven't, your next dollar, does your next dollar chase something that did well 3 years ago? Or does it chase something that might do well in the upcoming year? And that's the way you have to think when you're investing for the next couple of years.
Doug, my final question to you is, again, getting back to this political theme, as it is the day of midterm elections with voters heading to the polls. One other major political event that could be on the horizon is an official 2024 presidential run announcement by former President Trump coming next week. What impact might that have on the stock market?
Well, that's an interesting point. Now, again, we're going to have the Republicans win in 24 and have both houses, then you're back to non-divided government. I much prefer divided government regardless of how it shakes out. But I think what you have to look at is this government is trying to sort of stamp down growth to quell inflation. And previously, they were really sort of accelerating growth to try to grow us out of it. Two different philosophies. We can argue whether one is better than the other, but you may resume more of a pro-growth type of a policy situation. Neither of them, honestly, in all the years I'm doing this, I realized a long time ago, no one cares about the deficit. I don't care what they say. They don't. It's just which party in power wants to spend on what they want to spend on. So really what it comes down to is keeping the reins on that with divided government, but maybe get a little bit of a different type of a growth policy. You just have to know how to invest in and trade through that in the current situation or in that situation. Slightly different, but we can all make money in those situations no matter what they are.
All right, Doug Flynn, co-founder of Flynn Zito Capital Management. Doug, thank you so much for coming on the show.